The global currency war has reached a new level. Across Asia, China is quietly rewriting the world's financial map, one trade agreement after another. More and more countries are now settling in yuan, gradually moving away from the dollar that until recently dominated every transaction. Panic is growing in Washington. The U.S. Treasury has just injected $20 billion to save Argentina's collapsing economy, hoping to maintain the dollar's influence in South America. But this move is not about help, it is about control. It exposed how fragile America's financial power has become, while its rivals build their own systems bypassing the dollar. While Beijing expands its influence through trade and currency, Washington spends billions simply to avoid retreat. And this battle is already going beyond individual regions, from the currency crisis in Argentina to the collapse of the yen in Japan. The global monetary order is beginning to crack. China has done what seemed unthinkable just 10 years ago. It banned all new iron ore shipments from BHP Group, the world's largest mining company. The order came directly from China Mineral Resources Group, a state entity created to give Beijing more control over global commodity prices. All Chinese steel and trading companies were instructed to immediately stop purchasing new BHP ore shipments if they are priced in dollars. Even cargoes already en route from Australia were frozen and could only be sold if priced in yuan. This sudden decision marked a turning point for one of the most critical supply chains on the planet. China buys nearly 70% of all seaborne iron ore, and BHP is one of the 3 companies, along with Rio Tinto and Vale, that supply China's massive steel industry. For years, Beijing depended on these suppliers, but the situation is changing. Domestic steel demand is falling, and huge volumes from Guinea's Simandou mine are about to enter the market. For the first time, China feels confident enough to dictate its own terms. Analysts note that the decision is not only about prices, but also about currency control. By suspending dollar-based transactions, Beijing is pushing the world's largest commodity trade toward yuan settlements. Shipments that have already arrived in China and are priced in yuan remain available, sending an unmistakable signal. If you want to trade with us, use our currency. Markets reacted immediately. Iron ore futures in Singapore jumped by 1.8% to $105 per ton, while BHP shares in London plunged nearly 5%, the largest drop in months. This is far from the first time China has used commodities as a pressure tool. Earlier this year, Beijing restricted rare earth metal exports, and now it is hitting the foundation of global industry, iron ore. Created just 3 years ago, CMRG carries out China's strategic mission to shift pricing power from mining corporations to Chinese industry. The message to global markets is clear. If you want access to the world's largest buyer, you play by China's currency rules. As Beijing expands this strategy from metals to energy and agriculture, the pressure on the dollar system will only grow, setting the stage for a swift response from Washington. Washington's sudden decision to allocate $20 billion to Argentina shocked both markets and Congress. The program proposed by Treasury Secretary Scott Bessent was presented as an attempt to stabilize the peso's collapse. In reality, it revealed how desperate the U.S. is to maintain its influence in the dollar zone. Under the Treasury and Fed plan, a $20 billion currency line was created with Argentina's central bank, and direct peso purchases on the market began, an unusual and risky measure aimed at slowing the currency's fall. But the Argentine economy is on the brink. If the peso continues to fall, the United States will have to rescue Argentina again to avoid losing another country from the dollar's orbit. These $20 billion bought time but turned Argentina into a hostage of Washington. One of the key conditions set by the Treasury is to keep exports in dollars and maintain reserves in the same currency. On paper, it looks like stability. In reality, it is financial dependence. Every step by the Federal Reserve now echoes in Buenos Aires. Rate hikes in the United States strengthen the dollar and pressure the peso. Markets already sense the imbalance. Hedge funds are opening short positions against the peso, testing how far Washington is willing to go to defend it. If the central bank depletes its dollar reserves, inflation will explode again, and a new round of bailout talks will begin. Argentine bond yields are already hovering around 13 to 14%, showing that investors expect the crisis to continue. For the United States, this is becoming a dangerous loop. Every new bailout not only burns political capital, but also fuels frustration at home, especially when millions of Americans face rising debts, prices, and economic instability themselves. But the most troubling part is the strategic consequence. The more Washington props up weak economies with borrowed money, the more obvious its own vulnerability becomes. While American officials struggle to keep Argentina in the dollar's orbit, China moves quietly but effectively, buying its soybeans and offering its own financial safety nets. And the trap is becoming clear. By defending the dollar abroad, Washington may undermine it globally. While the US spends billions to prevent Argentina from exiting the dollar system, China turns the crisis into an opportunity. Just days after Buenos Aires announced temporary tax holidays for agricultural exports, Chinese state grain companies moved in. According to reports, they purchased 35 shipments of soybeans directly from Argentine suppliers, bypassing American markets. For Chinese importers, the logic is simple. Argentina needs dollars, and China has yuan. These deals came as American farmers were already under pressure from falling exports and shrinking global demand. According to the U.S. Department of Agriculture, American soybean shipments to China in 2024 fell by almost 25%, while imports from Latin America rose. That new wave of Argentine sales triggered alarm and frustration in Washington. Donald Trump's advisors are already discussing a new $10 billion aid package for farmers, similar to the one introduced during the previous trade war. For Beijing, every transaction settled in yuan is a step toward consolidating its position in global trade. Meanwhile, the currency crisis in Japan continues to deepen, and the numbers are becoming increasingly alarming. Over the past 6 months, the yen has depreciated by nearly 6%, the steepest drop in 2025. In October, the exchange rate hit 154 yen per dollar, its lowest level in more than 30 years. Behind the scenes, the new Prime Minister Sanai Takaichi has made it clear that her priority is fiscal stimulus, not currency defense. She called raising interest rates foolish and stated that Japan must support exports and boost domestic demand even if it leads to further weakening of the yen. But this policy has a dangerous downside. Every drop in the yen makes imports of oil, gas, and food more expensive. Inflation, which had long remained below 2%, has now approached 3.5%, eroding savings and forcing families to cut back on nearly everything. Meanwhile, Japan's national debt has surpassed 1.3 quadrillion yen, roughly 260% of GDP, and is becoming increasingly difficult to manage as bond yields rise. Investors are demanding higher returns to keep holding Japanese debt, undermining confidence in one of the world's largest bond markets. The Bank of Japan is trapped. It already owns around 51% of all government bonds, while foreign investors hold less than 6%. If yields continue to rise, the Bank of Japan is forced to buy even more, effectively printing money to close the gap. But every such intervention only weakens the currency further, fueling a vicious cycle that is becoming harder to escape. For exporters, a weak yen means short-term gains, but for ordinary citizens, it means rising prices, shrinking purchasing power, and a lower standard of living. Japan is teetering between inflation and insolvency, and Washington is closely watching. If the yen's decline continues, it could trigger a new wave of shocks across global markets already strained by US trade and currency wars. Cracks are spreading faster than Washington can patch them. China is building a new trading system based on the yuan. Argentina is drowning in dollar debt, and Japan is sinking under the weight of its own currency weakness. The global financial balance is shifting, and every new bailout only underscores how fragile the old order has become. The dollar has ruled uncontested for decades, but the fight for control has truly begun. The next crisis may not be born on Wall Street, but in the currencies that feed that market. How much longer can America keep paying to stay on top? And to stay up to date with all the events, make sure to subscribe and turn on notifications. See you in the next video.